Witness the digital erasure of $5 trillion in market value, a financial cataclysm that permanently etched itself into dot-com bubble history. This was not a slow decline, but an instantaneous implosion, a sudden violent re-evaluation of reality that obliterated entire industries and fortunes overnight. An entire generation of entrepreneurs and investors found themselves caught in a market correction so profound, its echoes still shape investment strategies today. The sheer scale of capital injection into these ventures was unprecedented, bordering on the absurd. Billions flowed into companies with no revenue, no tangible assets, and no clear path to profitability, raising the critical question: how did an entire ecosystem convince itself that the laws of gravity no longer applied to digital enterprises? And what were the precise mechanisms that sustained such an impossible illusion for so long? We are here to perform a corporate autopsy, dissecting the raw financial data and market psychology that built a $5 trillion mirage. This analysis bypasses the narratives of genius or folly, focusing instead on the cold, hard numbers and the inevitable consequences of their distortion. The dot-com bubble was not an act of God, but a predictable economic phenomenon rooted in unsustainable growth and speculative investment. Consider the metrics of this illusion at its peak, numbers that, in retrospect, seem like a dark financial comedy. Companies with zero revenue could command valuations exceeding $1 billion, based solely on nebulous metrics like projected eyeballs or user stickiness rather than concrete earnings. Peak market capitalization figures often reached hundreds of times their annual sales, where sales even existed, signifying a complete detachment from traditional valuation methodologies. Cash burn rates for unprofitable startups frequently exceeded $20 million per quarter, with no sustainable revenue streams in sight to offset these colossal expenses. Total liabilities ballooned as these entities borrowed against their inflated market caps, compounding their future obligations without generating corresponding assets. Customer acquisition costs, a critical unit economic metric, regularly dwarfed the lifetime value of those very same customers, creating an inverted profit model from the outset. Many companies spent fortunes on aggressive marketing campaigns, often during the Super Bowl, without a product truly ready for market or a clear path to monetization. These expenditures were funded by successive rounds of venture capital, each pushing valuations higher based on the previous round's inflated price. The prevailing logic, if it could be called logic, was get big fast and worry about profits later. This mantra encouraged reckless spending and a disregard for fundamental business principles, often under the guise of capturing market share. The primary financial mechanism of death for countless dot-coms was a simple, yet devastating, cash flow crisis. When the well of easy capital began to dry up, companies accustomed to burning millions monthly suddenly faced an existential threat. Their operating models were fundamentally broken. They were built to consume capital, not generate it. The perceived value of these firms was not tied to their present-day balance sheets or income statements, but to an imagined future dominance that rarely materialized. Unit economics, the bedrock of any sustainable business, were either ignored, misunderstood, or aggressively reinterpreted to fit the narrative of perpetual growth. Businesses were essentially paying more to acquire a customer than that customer would ever generate in revenue, a mathematical certainty of long-term failure. This was often masked by the rapid user growth numbers, which venture capitalists eagerly highlighted to justify ever higher valuations in subsequent funding rounds. The illusion was perpetuated by a feedback loop. High valuations attracted more capital, which funded more marketing, which drove more user growth, which justified even higher valuations. This cycle continued as long as capital was cheap and investor sentiment remained irrationally exuberant. The lack of barriers to entry in many digital sectors also meant intense competition, further driving up customer acquisition costs and depressing profit margins, even for the few that managed to generate revenue. The market treated potential as actual and future earnings as current assets, a dangerous redefinition of financial reality. This allowed companies with negative cash flow and non-existent profits to be valued alongside established, profitable corporations, creating a massive market distortion. The market rewarded scale over sustainability and hype over tangible results. A critical boardroom turning point, though not confined to a single entity, manifested in a widespread strategic miscalculation across Silicon Valley. Companies consistently prioritized market share over profitability, deferring the imperative to generate actual earnings indefinitely. This approach was encouraged by venture capitalists who pushed for rapid expansion, believing that dominance alone would eventually translate into profits, even without a clear monetization strategy. The decision to pursue user growth at any cost, rather than focusing on building sustainable business models, became a fatal systemic flaw. For many startups, the business plan was simply to attract enough users to be acquired by a larger company, a strategy that evaporated when the larger companies themselves began to struggle. The broader market shift from valuing abstract potential to demanding concrete profits was a critical inflection point. This change wasn't an isolated event. It was a macroeconomic reality that began to assert itself in late 1999 and crystallized in early 2000. On May 16, 2000, the Federal Reserve raised the federal funds rate by 50 basis points. This seemingly minor policy adjustment had catastrophic ripple effects, signaling a definitive end to the era of cheap, abundant capital. The cost of borrowing increased, making speculative investments less attractive and pushing investors towards safer, more established assets. Venture capital firms, which had fueled the dot-com boom with seemingly endless funds, suddenly found themselves unable to raise new money or justify further investments in unprofitable ventures. This dried up the continuous supply of liquidity that had propped up the entire speculative ecosystem. The strategic decision to rely on an ever-present flow of external capital, rather than internally generated profits, became the ultimate undoing. Companies that needed continuous infusions of cash to merely survive suddenly faced a barren landscape. Their boards, once eager to approve massive marketing budgets and expansion plans, were forced to confront the harsh reality of their balance sheets. The focus shifted from growth at all costs to survival at any cost, leading to mass layoffs, forced liquidations, and desperate pivots that often came too late. The market's patience for promises had run out. It began to demand performance. The post-mortem conclusion is stark and unambiguous. Silicon Valley's $5 trillion illusion exploded because it was fundamentally unsustainable. It was built on a foundation of speculation, not sound financial principles. The collapse was not merely a case of bad leadership or unfortunate timing. It was a systemic market failure predicated on a fundamental mispricing of future potential and a widespread disregard for present-day financial reality. The open loop from our introduction, asking how an impossible illusion sustained itself for so long, finds its resolution in the temporary detachment of valuation from any underlying economic fundamentals. This detachment was driven by unprecedented liquidity, widespread market euphoria, and a collective belief in a new economy where traditional rules did not apply. The mechanisms that sustained the illusion were continuous capital injection, aggressive marketing masking product deficiencies, and an investment community willing to accept potential overprofit. The moment capital became expensive and investors demanded tangible returns, the illusion dissolved. The market reasserted its demand for profitability, for positive cash flow, and for unit economics that made mathematical sense. The lesson is not one of moral failing but of economic inevitability. Valuations cannot indefinitely diverge from earnings, and growth funded solely by external capital without a path to self-sufficiency will ultimately face a reckoning. The dot-com bubble stands as a monumental cautionary tale in financial history, demonstrating the dangers of speculative excess and the relentless gravitational pull of economic reality. If you found value in dissecting the anatomy of this colossal collapse, then our next forensic examination into the financial engineering and ultimate unraveling of long-term capital management will provide even deeper insights into the systemic risks inherent in unchecked market speculation.